Before you invest in a stock, it's very important for you to understand the company's business by reading through its annual report and understanding the quarterly results. In this video, I'll talk to you about what to look for when a company announces its quarterly results. Every listed company announces its results once in every quarter. Through these results, the company updates its financial position so that the investors can make an informed investment decision. But the problem is, most of the investors fail to understand what the company is trying to report and often ignore them. So let's start with the basics and try and understand how we can analyze the quarterly results of a company. A financial year starting from 1st April to 31st March is divided into 4 quarters. Quarter 1 is between months April to June, Quarter 2 is between the months July to September, Quarter 3 is between the months October to December, and the last quarter is between January to March. You may be interested to know that in India, financial year starts from 1st April and ends on 31st of March. But in the US, the financial year also coincides with the calendar year, so their financial year starts from 1st January and ends on 31st of December. Coming back to the Indian financial year, the end of second quarter, that is in September, also coincides with the half-yearly closing of a company. Likewise, the last quarter ending in March also coincides with the full financial year close of a company. Hopefully with that, there is no confusion on when the quarter starts and when the quarter ends. Now, before any company can announce its quarterly results, the company's investors and the analysts tracking these companies already have some sort of expectations about what kind of earnings the company is expected to report. These expectations are collectively called as the street expectations. Here are a few important things for you to note. If the actual results announced by the company is higher than what the street is expecting, then it is said that the company has delivered a positive surprise. Usually, whenever there is a positive surprise, then the stock price tends to rally. If the company's earnings are lesser than what the street is expected, then the stock price usually tanks. Now here is a funny thing. If the results are in line with what the street is expecting, then too the stock price can decline. Now this is because the street is always expecting a positive surprise. For example, if the company announces a 8% growth in revenue and the street was also expecting an 8% growth, then don't be surprised if the stock price cracks. This is because the 8% growth is already been factored by the stock prices and the street was expecting something more. And I'm fairly certain that you've seen this over and over again in the stock markets where the company announces a positive result, yet the stock price cracks. Now you know why. Moving ahead, let me list down a few things that you need to pay attention to when a company announces its quarterly results. In percentage terms, look for the growth in revenue terms. While looking at the growth, also look at parameters that contribute to the revenue growth. For example, look for volume sales when you're looking at FMCG, steel, cement, and auto sectors. Revenue per user in telecom, revenue per room available for hotels, and revenue per seat for airline companies. If you're looking at IT and infrastructure firms, look at the size of the order book and analyze the pipeline. EBITDA and EBITDA margins are important as well. Pay attention to what the company has to do with respect to capex expansion. Look for depreciation and additional loans taken by the company. Look for details related to depreciation and finance cost. These parameters can have an impact on the bottom line of the company. Next, look for EBIT margins. EBIT margins denote the actual operating efficiency of a company and reports what the operating margins are. Look for PAT margins. We want the company to exhibit stable PAT margins and also a predictable trend. Check if the company has reported any exceptional item gain or losses. Check for other income details. See if the company has sold any of its assets and recognized a huge gain in terms of other income. Conference call transcripts and revenue guidance is super important. Pay attention to what the company's management has to say about the quarter gone by and what they expect for the upcoming quarter. Today, there are AI tools that will help you summarize the conference call transcripts, so please do make use of them. Usually, investors love it when the company's management gives a positive guidance on revenue and profitability. But that said, investors also appreciate if the management gives clarity on what headwinds they anticipate for the upcoming quarters and if at all revenues are going to take a hit. Management guidance is the route for building the street expectation. So please pay as much attention as possible for these guidance. Lastly, also pay attention to what the company has to say in terms of corporate actions. Corporate actions include dividends, stock splits, bonuses, etc. You can find details in the notes associated with P&L. We are not done yet. There are a few more things I want you to pay attention to when analyzing a quarterly report. When a company announces its quarterly results, check how the company has performed in terms of quarter-on-quarter growth. What were the company's earnings and profitability in the previous quarter versus this quarter? This comparison helps you understand how the company is faring if there was an exceptional gain or loss in the previous quarter. Compare this quarter results with the same quarter last year. For example, if the company has announced September quarter results for this year, see how the company reported its earnings for the same quarter last year. This comparison helps you identify seasonality in earnings and margins. For example, if you're talking about a travel company, then families may not like to travel in the month of September as there are exams for children. This means to say for this particular company, every September quarter there will be a dip in revenues. This is the seasonality I'm talking about. Pay particular attention to the second quarter results, which also coincides with the half-yearly closing for the company. In this quarter, company also updates its financial position in terms of cash flow and balance sheet. This information enables you to compute all ratios such as ROE, ROA, working capital, inventory, turnover ratios, cash conversion cycles, interest and debt coverage ratios. Also, before making an investment decision, see how the company has performed in this quarter and several quarters before. Don't be in a hurry to base your investment decision on just 1 or 2 quarterly results. One last thing, you may be interested to note that analyst tracking companies build financial models. A financial model is built on a set of assumptions. When the quarterly results are announced, analysts update their financial models by replacing the assumed numbers with the actual numbers. This way, they fine-tune their financial models to ensure that the financial model is in sync with reality. Of course, the same model will be used by analysts to make future predictions of what the quarterly results are likely to be and then set the street expectations. Lastly, when you are looking at the quarterly result of a company, pay attention to how the other companies in the same sector are performing. This will give you a sense of how the industry as such is performing and also help you understand how your company is standing out in the industry. Do let us know in the comments what else you look for in a company's quarterly results.